Yeah, I tend to think that the growth stage is the most troubled and challenged because at the early stage, you can get a guy like Saks or JCal on your board and you can grind. And I think that that's really important to get to product market fit. And at the public stage, you can get somebody like me and, we can help transact and actually help optimize and run the business for scale and value. But in the middle, you have all of these weird dynamics that no longer don't make as much sense. So just to give you a sense of it, the average deal size, okay, so the typical round is up 3x over the last 10 years. 3x.
That is absolutely anecdotally my experience.
In late stage, investors are doubling and tripling down on these mega deals so that average round size is up 5x in the last decade. The typical pre-money on a growth stage deal in 2010 was 100 pre. This is for the top quartile. And it's now, this is for the average. It's now...
This is for a growth stage?
Yeah, growth stage. 100 pre. It's now 570 pre.
Wow.
Yeah, that's getting crazy.
It's really getting crazy. Tiger, it says here in the notes, Tiger Global has announced a deal, according to PitchBook, every 48 hours in 2021.
Well, here's the interesting thing about
That's fabulous. That's fucking fantastic.
What Tiger, I think, has figured out is they started as public market investors and worked their way down the stack, right? So they're very familiar with the public market valuations. They're seeing that these SaaS companies are, I remember 10 years ago when I was doing Yammer, we thought that the best outcome that you could have as a SaaS company was like a $1 to $2 billion exit. That's why when Microsoft offered us $1.2 billion in 2012, we took it, right? We're like, we could work 5 more years, maybe get to a $2 billion outcome. Well, now you're seeing what Slack just got acquired by Salesforce for close to $30 billion. It's pretty routine to see SaaS companies IPOing at now 10, 20, 30 billion and up. And so the exits are just so much bigger than anybody thought 10 years ago. And we were the optimists, by the way. There's a good tweet on this by, it was Jay Malik. Basically, he gave some stats. He said that if you're wondering why everyone wants to invest or be a VC today, the stats from PitchBook provide an answer. We had 43 billion in exits in 2010. We had 290 billion in exits in 2020. So we had about 7x roughly greater exits over the course of a decade. Now, the average deal size has grown 3x and there's a lot more money going into venture capital. But the reason why you're having all this money go in and all these new players is because the outcomes are so much bigger. And then he said, and I agree with this, wouldn't be surprised if VC hits 1 trillion by 2030. So we're seeing I remember 20 years ago when I first got into the business, like Silicon Valley was this small little concentric circle around Stanford. And now it's spread to San Francisco and the entire Bay Area and to other cities. And it just keeps getting bigger and bigger.
Continents.
It's the digitization of every market, right? I mean, every traditional business, every traditional industry is being digitized in some way or another. And so it's no longer a tech enabler of other industries. It is the industry itself.
We know that the brand really matters in the early stage because they anoint you and they bring so much value in terms of working with you to solve problems. We know with SPACs, and IPOs, whoever is anointing that really matters, right? The sponsor. But in the middle, is all that cash now moved to a game of who will pay the most for the least rights? In other words, Series B to, when you get involved, Chamath, is that just...
It's such a good point. So what you're now teeing up, Jason, is this next big category, which is if it's undifferentiated capital, at some point you're going to go to the logical conclusion, which is, I don't want any dilution from this. I'm happy to take dilution in the Series A when I get, Kraft or Sequoia or Benchmark. I'm happy to take dilution in the IPO because that's sort of the necessary process of, diversifying the stock ownership, getting, my users and my customers to be able to own the stock, et cetera, et cetera. But in the middle, now you have these companies like Pipe and Clearbank, where now all of a sudden you can grow, Jason, in your B, C, D rounds, and you have zero dilution. So if you're a founder, the best formula is going to be take Series A and seed capital from an expert single, GP brand person who knows that business category so well, right? If you're starting a SaaS company, you should probably get your seed from Saks, raise your A from some expert, or wait, let me say it differently. Seed from JCal, A from Saks, and then go to Pipe and Clearbank and fund it all based on your recurring revenue growth. Yep. And then go public via SPAC. So just to give you some data that I got from Pipe and Clearbank. Which means
you would, just to give people an idea of what the cap table would look like there, you would dilute 10% in your seed round 20% in your A. Now you still have 70% of the company, and you just sell your yearly contracts ahead of time to Pipe,
Correct.
and you're done.
By the way, can I tell the story about Pipe? So Pipe,
yeah, it's
Pipe,
kind of painful. Thanks for including Freeberg. and I.
David, can I give the stat from Pipe and then
yeah,
you tell the story?
yeah, go ahead.
Sorry, you guys are all investors in this company?
No, not me and you, David. They let us. Our beaks
Honestly,
are dry.
my beak is
dry
so
and
wet.
chafing beaks.
My beak is so wet.
Can we get a profile of that beak? Let's see
I don't know why I'm
Let's see
it
it today.
is- it is
Oh
a-
my lord!
It is.
People don't realize it really is. Hold on. Do
It's
it
a
one more
beau- it's
time
a-
and let me
I've-
compare it to this.
Okay, it's a beautiful
Pretty
beak.
No, I'll tell.
Pretty close.
Let me tell the Pipe beak wetting story because Harry, the founders, told the story. He came in to meet with me in my office at Kraft. This is pre-COVID when people actually met in person. Our principal, who's based in LA, Michael Tam, knew Harry from his previous startup and brought him in. I heard the pitch, which is basically to advance the full value of these contracts for SaaS companies and others. But it was so obvious, right? Because if you're a SaaS company, you spend roughly about a year of revenue on CAC, customer acquisition costs. But the customer only wants to pay you monthly. And so you have this huge negative cash flow cycle. So what if you could just take that contract and monetize it right away, get the full value of the contract advance, then you can plow it into the next customer acquisition costs. And you don't need to dilute yourself with venture capital. I said yes to Harry in like 15 minutes. I think it's the quickest I've ever given a term sheet. We invested $2 million in the company at a 12 cap. And we did the deal that day.
So within 9 months of launch, Pipe has connected 3,500 customers and over $1 billion plus of ARR to investors willing to purchase that revenue.
And to be clear, it's a marketplace.
And so,
so
Right.
they're not buying the debt. Anybody can go on the marketplace and say, I will buy Slack's revenue for 91 cents on the dollar, but something more speculative, they might pay 85 cents
This is
on
a
the dollar.
brilliant thing is that they're not providing the lending off their own balance
As
sheet.
opposed to
They're-
Clearbank, which does and charges 6%
I'm done
every
talking
60
about
days.
your book unless you guys share.
Hold on,
equity
I'm gonna
with
go to-
the rest
I'm
of
gonna
us.
go to-
I really-
This
I
is
really
fucking
care less.
bullshit, guys.
Yeah.
Listen,
I'm gonna
asshole.
go.
Want
I'm
some
gonna
fucking shares. Let's go.
go ahead and
So-
do my email now.
Yeah, I'm good. Let's do it, Freeberg. Hey, Freeberg, let's launch a bio company together and we'll block out these beaks.
Go work on your life extension. We're working on our monetary extension right here.
Yeah,
So
you need more
Clearbank-
money. You need more money.
So Clearbank works with e-commerce companies. So what you do is you stitch in your connections to Shopify and Stripe, etc. They're able to monitor how well you do, and then they'll basically help finance you, again, non-dilutively. So Clearbank companies captured 55% more growth in 2020 than the prior year. So even in the midst of COVID, these companies did really well. They have revenue-based financing. They've invested $1.6 billion to date. And it turns out that, their investor composition, 8 times more women funded than traditional VC. By the way, I want to be clear. I was also a Series A investor in Clearbank. I mean, I am such a believer in this middle section of venture disappearing. Like when you have these growth rounds, they're undifferentiated and they shouldn't be dilutive in any way, shape, or form. The founders should figure out how to grow non-dilutively the minute that they have some semblance of product market fit. So then the dilutive points are the bookends.
Yeah, this
That's
was
it.
kind of the idea with like Indiegogo and some of the GoFundMe types, or not GoFundMe, the other things where you could basically pre-sell consumer products too, right? Where you could get funded in a similar way, and you could see the same transitioning into kind of hardware businesses and other consumer businesses, right?
There's an even bigger trend that happened that I can talk to, which is equity crowdfunding CF. But I don't want to take you off your deck. So do you want to keep going on the deck, or do you want to stop?
The only